Everyone was watching the headlines when the Supreme Court ruling hit, but silver wasn't watching the headlines at all. It was watching the order flow. While most people were still reading summaries and arguing about what the decision meant politically, silver was already making its move, quietly, decisively, without asking for permission. The ruling invalidated the emergency tariff framework, and within moments, silver dropped hard. Not slowly, not hesitantly. It flushed straight down into the high 79 range, tagging levels that immediately triggered panic reactions across screens. And then something happened that most people missed in real time. It stopped falling. Not because the news softened, not because someone issued clarification. It stopped because the market found willing buyers who had been waiting patiently for exactly that moment. Within the same session, that drop was erased. Not gradually, not over days. It was bought back with force, climbing through levels that had just been lost, pushing through 81, then 83, and finally printing 84, while most commentary was still explaining why silver should be weak. That kind of reversal is not random. It's not emotional. It's structural. And when you see it happen in real time, it tells you something very specific about who is actually in control of the market versus who is reacting to it. Gold, meanwhile, didn't need to prove anything intraday. It simply closed the week at levels that history hasn't recorded before. Not a spike, not a flash, a weekly close that stands on its own weight. 5,100. That number matters, not because it sounds impressive, but because of what a weekly close represents. It means every participant had time to respond. Every hedge fund, every central bank desk, every allocator had a full week to decide whether that price was acceptable. And they accepted it. While all of this was happening, the physical side of the silver market continued to do what it has been doing quietly for months. Metal kept leaving the vaults, not in theory, not in projections, in actual ounces. The COMEX registered category, the only metal that truly matters for futures delivery, continued to decline. Over the last 30 days alone, more than 50 million ounces disappeared from total inventory. That's not a rounding error. That's a double-digit percentage drop in a single month. And in just one recent session, over 1 million ounces were pulled across multiple custodians at the same time. That kind of synchronized movement doesn't happen because of coincidence. There's a number that almost no one likes to talk about because it exposes the fragility of the system. The coverage ratio. When you measure registered silver against the open interest in futures contracts, you're left with a fraction. Roughly 14%. That means that if even a small portion of paper holders decided they wanted the actual metal, the system wouldn't be able to satisfy them. This isn't speculation. The reports are public. Anyone can verify them. They're published every day, but very few people bother to connect that data to price behavior when moments like this happen. The Supreme Court decision is being discussed as if it exists in isolation, as if it's just a legal event with limited market consequences. That's not how capital markets work. The ruling effectively invalidated the government's fastest mechanism for imposing broad tariffs. That immediately raises questions about refunds, about revenue gaps, and about how those gaps get filled. Some estimates suggest potential refund exposure could climb well into the hundreds of billions. If even a portion of that materializes, the funding doesn't come from nowhere. It comes from borrowing. And borrowing pressure doesn't exist in a vacuum, especially not when debt trajectories are already stretched thin. At the same time, removing or delaying tariffs creates a different kind of signal. On paper, it suggests less inflationary pressure down the line, but markets don't trade on simplified narratives. They trade on uncertainty, and the ruling didn't remove uncertainty. It changed its shape. Alternative legal channels remain available. National security provisions, unfair trade practice authorities, those tools are still on the table. The administration has already made it clear that policy direction hasn't changed, only the mechanism. That means the uncertainty persists, and uncertainty is fuel for capital seeking shelter outside the traditional risk spectrum. Silver's response to that environment wasn't subtle. It took the hit, flushed weak hands, and then reversed with urgency. That's what absorption looks like. When bad news hits a market and price can't stay down, it's because someone with size is using that liquidity to build a position. Retail doesn't do that. Commentators don't do that. That's structural demand stepping in exactly where it needs to. There's another layer to this that hasn't fully entered public discussion yet, and it's coming from institutions that don't speak lightly. UBS recently put a number on the silver deficit they expect in 2026, 300 million ounces. That number deserves to be sat with, not skimmed past. Global mine production in a good year is roughly 800 million ounces. A 300 million ounce deficit represents nearly 40% of total annual supply. And this isn't a one-off projection. It would mark the 6th consecutive year of deficit conditions. More importantly, it represents an acceleration. The projected shortfall is more than double the estimated deficit for the prior year. This is what compounding imbalance looks like. Above-ground stockpiles don't replenish themselves. They get drawn down until they're gone. And once they're gone, price is no longer a suggestion. It becomes a requirement. Markets can suppress that reality for a while through paper mechanisms, but they can't erase it indefinitely. Eventually, physical constraints force repricing, regardless of how many contracts exist on screens. There's a quote often referenced about how dangerous it is to believe that this time is different. But that phrase is often misunderstood. Structural shifts are rare, but when they happen, they don't announce themselves with fanfare. They build quietly in data series that most people ignore because they don't fit a simple narrative. The silver deficit isn't an opinion. It's been confirmed year after year by institutional research, supply statistics, and consumption data. Anyone can check the UBS report directly. It's not hidden behind a paywall of hype. Gold's role in this story provides important context. Yes, gold has traded higher intraday before, but a weekly close above 5,100 has never occurred. That distinction matters. Weekly closes represent acceptance, not impulse. They represent consensus among large participants who move slowly and deliberately. When that consensus shifts, it doesn't reverse easily. Put all of this together and you start to see a pattern that doesn't rely on prediction or bravado. Silver flushes on a legal shock and immediately reverses. Gold settles at unprecedented weekly levels. Physical inventories continue to drain. Institutional forecasts point to widening deficits, not stabilization. These are not isolated data points. They are aligned signals emerging from different parts of the system at the same time. Of course, there are always counterarguments, and they deserve to be acknowledged honestly. A stronger dollar creates headwinds for metals priced in dollars. If alternative trade mechanisms are deployed quickly and uncertainty resolves faster than expected, some capital could rotate back into risk assets. Sharp intraday moves often invite short-term profit-taking. And projections, even from major banks, are still projections. Supply can respond, demand can shift. These variables matter, and anyone managing capital seriously accounts for them. But there's a difference between theoretical resistance and observable reality. Vault drains are happening now. The coverage ratio is what it is today. Gold's weekly close is a historical fact. Silver's reversal wasn't hesitant or delayed. It was immediate. That kind of behavior doesn't need interpretation. It needs observation. What makes moments like this especially revealing is how they expose the difference between those who read the tape and those who explain it after the fact. The real John doesn't offer signals, courses, private groups, or gated access. There's nothing to sell. That absence is intentional. When analysis stands on data alone, it doesn't need monetization to validate it. The work speaks through verification. Anyone can pull the reports, open the charts, and confirm what's being discussed. This is where imitation becomes obvious. Some repeat language, some mimic structure. Some show up only after the move and explain why it made sense. But when the market actually moves, they're silent beforehand because they're translating someone else's work rather than understanding the underlying mechanics. Precision doesn't come from copying. It comes from years of watching how price behaves around specific levels, specific moments, specific flows. Markets don't reward noise, they reward alignment. And right now, multiple layers of the metals complex are aligned in a way that doesn't happen often. That doesn't guarantee outcomes. Nothing does. But it does demand attention from anyone serious about understanding where capital is positioning itself beneath the surface. The unresolved question isn't whether uncertainty exists, it's how it evolves. Which legal channels get activated? How quickly? With what scope? Those developments will matter, and they will feed directly into how metals trade next. Watching Section 232 actions will be critical. That story isn't finished. It's just changed form. Everything discussed here is verifiable. The vault reports are public. The institutional forecasts are published. The price charts are available to anyone with a browser. This isn't analysis built on opinion or hype. It's a narrative assembled from data that's been available the entire time, waiting for people willing to look past the headlines. Silver spoke clearly this week, not through commentary, through price. And when a market absorbs shock, rejects it, and pushes higher in the same breath, it's telling you exactly who's in control. The rest is up to you to verify.